Which tech giant has the worst stock equity compensation for their employees? Amazon, Uber, and Netflix. Three tech giants, three wildly different approaches to stock equity compensation for their employees. But here is the real question. Which one of them does it the worst? By the end of this video, you will understand how Uber, Netflix, and Amazon issue and approach equity compensation for their employees. And you will be able to make a decision whether this powerful tool is right for your business. So let's jump in. What is equity compensation? At its very core, equity compensation is very simple. Instead of paying an employee in all cash, you give them some part of their payment in stock. You give them some ownership in the company. This can be in the form of stock options if you're a private company, or RSUs, restricted stock units, if you are a public company or about to go public. Both of these are valid mechanisms. Essentially, what you're doing when you give stock to an employee is saying, hey, you are driving so much impact for the company. I want you to have partial ownership in the company and share in the success of the company. Hence, when an employee drives a lot of impact and it really impacts the company, you'll see the stock price going up, which of course benefits everybody. And you'll also see that when they have partial ownership or some part of the stock, then they benefit financially from this. Hence, driving even more ownership. But stock compensation isn't just about being a tech company or feeling cool or, saving cash. It is actually a very powerful mechanism which can transform how your employees think about their work and their relationship with the company. It's one of the most powerful mechanisms to drive extreme ownership mindset in your employee base. Amazon's strategy, the back-loaded beast. Amazon has one of the most unusual equity compensation structured in all of tech, and it is designed with one primary goal in mind: employee retention. Here's how it works. When you join Amazon, you receive a grant of RSUs as part of your compensation package. But unlike most tech companies where the grants vest evenly over 4 years, Amazon has what you call as a backloaded vesting schedule. The initial grants vest in 5%, 15%, 40%, 40% over 4 years. What does that mean? It means that if you've received a grant of, let's say, $100,000, year one, you would only get $5,000 out of that. Year two, you'll get $15,000, year three, $40,000, and year four, $40,000 as well. This means that 80% of your stock compensation you will receive in the last 2 years of your 4-year vesting schedule. Why is Amazon doing this? It is actually a brilliant retention strategy. Just as employees are becoming highly skilled in the job, they know all the systems, they know how to be immensely productive, that is the time when they receive their highest compensation in the company. And to top it all, Amazon's seen a lot of stock appreciation over the years. So initially, you may think you have a certain amount of grant, let's say 100,000, but by year 3, that same grant has now converted to 300,000 just because of how the stock has performed over the years. So effectively, in your last 2 years, you are getting a huge pay bump without even, really doing anything very differently. It's a very unique strategy. There is one downside to it though, that the first 2 years at Amazon, you are essentially making less than what you might at other technology companies like Uber or Netflix or Meta or Google. To offset this, Amazon has layered another layer. They offer cash bonuses. So heavy cash sign-on bonuses. So year 1 and year 2, You get those sign-on bonuses where your equity vesting schedule hasn't yet kicked off, and then year 3 and 4 you get your full blown package. To top all of this, Amazon also offers very creative refreshers as part of their annual salary increases cycle. So if you are a high performing employee, there is a high chance you will get some version of a retention grant or a refresher grant that will layer on to some of your new hire grants. Effectively, Amazon has done a great job in using a very refined and sophisticated package for equity compensation, which hits their top goal of employee retention and employees having high cash compensation through their cash and equity compensation through their tenure with the company. What is Uber's approach? Uber grants are front-loaded to manage dynamic stock price changes. Uber employees receive RSUs that vest over 4 years like many other tech companies. However, unlike Amazon's backloaded approach, Uber offers a different vesting schedule depending on position. If for many technology roles at Uber, RSUs vest at 30, 20, 15 schedule, which means 35% vests in year 1, 30% in year 2, 20% in year 3, and 15% in year 4. So in your first 2 years, 65% of grants will already be vested. This is a very different approach. And why does Uber do this? Uber does this so it can handle stock price changes dynamically. Let's say you join and within a couple of years the stock price rises. Great, your 15 and 20% of RSUs will already be worth very, very high. And what do they do if the stock price drops? If the stock price drops, then they always have the choice to issue more grants and cover up and make up for the difference, but they don't have to commit for these higher stock grants upfront. Hence, really managing the stock dilution and equity burn rate very, very effectively. Uber uses stock compensation as a key way to retain top talent and uses a lot of discretion in tech roles, product roles, as well as engineering roles to ensure that they are able to hire the top talent and able to compete with startups and heavily venture-backed companies at any time. The lesson from Uber: equity compensation is powerful and is a good fit for many companies. However, you have to be thoughtful about your equity burn rate, about stock price changes, timing, and how you issue the grant. And what is Netflix philosophy? Cash is king, but we will give you options. So Netflix is one of those few tech companies which pays very high, 80th, 90th percentile of the market, yet stock is not a standard. How Netflix designs their pay packages is they will have market leading cash salaries. So they'll give you like a total amount which will place you in the higher percentile of the market. And then they will let you choose. They will say, you can have all of it in cash or you can have some of it in equity. And let you choose. What's also very interesting is, let's say you say, hey, I want 40% of my salary to go towards equity. They will give you a discounted rate for that. So let's say you have $1,000 worth that you wish to convert to equity and Netflix is trading at $500 that day. You will have a choice to get Netflix stock at $200. So at almost very different price than the market. It's very motivating for you to convert your cash into, almost instant money. What's also very fascinating about the Netflix strategy is there is no vesting schedule. So they literally give you stock like they give you cash. It vests immediately. It comes from a very deep-rooted philosophy that we want no golden handcuffs for our employees. If you want to stay and really want to contribute, that should be the only reason you stay. There should be no other reason for you to, stay at Netflix. So if you want to go, you're welcome to walk tonight. So it's a very different mindset, different thing. But having said that, Netflix does hire and attract some of the world's best and most talented people who have long tenure with the company, and you can see it reflected in their stock price and growth over the year. How should your company use equity compensation, and is it even the right fit for you? This depends. So when does equity really make sense as a mechanism to reward employees. I can think of 4 scenarios. One is you are in a growth phase. Your company is growing rapidly. Employees are working extremely hard and giving outsized impact, and you want your employees to share in the outcome and benefit from all the growth. That is a great time to use equity compensation. You as a company, second, need to conserve cash. If you are very tight on cash and cannot reward employees at the market level, then equity is a very good complementary tool. So you can give them partial cash payment and partial equity payment. This is an option that keeps employees happy as well as helps you with your goal of conserving cash. Third is you want deep alignment and mad or crazy ownership with your employees. That is another time where you make them part owners by allocating equity compensation and ensuring that they are deeply aligned with your goals, your mission as a company, and are very interested in getting the company to succeed. And fourth, almost the most pragmatic reason of them all is you are in a competing talent market where equity compensation is the norm. A great example is United States, especially San Francisco and Bay Area or Austin, Denver, where a lot of companies will offer equity compensation, and the best talent has access to both high cash as well as strong equity growth. If you are in one of these talent markets, then you should really consider if your company is in a position to issue equity. It will help you land some of the best talent out there. So here are 3 or 4 reasons that I just shared. One, you're in a growth phase. Second, you need to conserve cash. Third, you want deep alignment, deep ownership. And fourth, you are in a talent market where equity and issuing equity compensation to employees is the norm. So when should you be cautious about this? There are a couple of scenarios when you do need to be thoughtful or cautious. One is your stock is volatile or declining. At that time, especially if you are issuing stock options, there's a very high likelihood the stock options are going to be underwater very soon. Even if you issue all of this, lean into the dilution and equity burn, employees won't appreciate it. So that might be one reason why you want to hold off on offering more compensation. Second is if you are nowhere close to a liquidity event and don't have a path anytime soon to get to a liquidity event, this will again get your employees thinking and saying to you that equity comp at the company is just paper money. It may be highly valuable, but because there is no liquidity event, for years and years in sight, it's going to get your employees very anxious. So those are, a couple of reasons to maybe stay away from issuing any type of equity. So bottom line is giving employees ownership in the company and stock can be a very powerful mechanism and highly recommended in certain situations. However, there are certain situations where it's not the right fit for your company. You may want to lean in heavily into other types of compensation and then take it from there.